Hello and welcome to the second part of our technical analysis video. Today we will start with the moving average convergence divergence. MACD is one of the most well-known and used indicators in technical analysis. This indicator is made of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distance between them become the MACD. Convergence simply means the moving averages are moving close together, and divergence simply means they're moving away from one another. When the short-term EMA is above the longer-term moving average, the upper area of the indicator will show activity. When the short-term EMA is below the longer-term EMA, the lower area of the indicator will show activity. The center line, which MACD is plotted around, indicates where the EMA are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, usually marked in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26, and for the EMA it's 12 and 9 for the signal line. The further apart the EMAs, the greater the momentum. The further away the MACD will be from the center line. Traders use MACD and signal line crosses to indicate momentum trades. You can see how these crosses often match with market moves. Traders also use crosses to indicate where momentum is coming out of the market and use it as a signal to exit a trade. A classic trading strategy using a MACD histogram is to trade the divergence. One of the most common setups is to identify points on a chart where the price reaches a new swing high or a new swing low. But the MACD histogram doesn't, which signals a divergence between price and momentum. Unfortunately, divergence trade is not that reliable or accurate. It fails more times than it succeeds. Prices often have several final volatile bursts up or down that trigger stops and force traders out of position just before the move actually makes a sustained turn and the trade becomes profitable. Bollinger Bands. Bollinger Bands are a highly popular technical analysis technique. A Bollinger Band is plotted two standard deviations away from a simple moving average. So, a Bollinger Band is made of a SMA, and then two standard deviations plotted away from it. Now, the important part is that because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen and move further away from the average. And during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an indication that volatility is about to rapidly increase. The market spends most of the time within the bands, and when the price action reaches the edge of the bands, is often more likely to reverse and come back into range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI indicator. Bollinger Bands are not a standalone trading system. They are simply one indicator designed to provide traders with information regarding price volatility. It is suggested to use them with 2 or 3 other non-correlated indicators that provide more direct market signals. It is crucial to use indicators based on different types of data. Some of them can be moving average divergence convergence, MACD, and relative strength index, RSI. Confluence. Using multiple indicators and their signals to take a trade. Here we have the RSI and MACD we already looked at. Here at the beginning of the chart we can see RSI is moving into overbought territory. This indicates that the market will reverse. However, we want something to help us filter out false signals on the RSI, so we should also look at MACD to give us confluence. We can see it indicates momentum is coming out of the market, and we have a MACD cross here on the graph as a signal to enter a short trade. We can also use opposite signals as exit signals to indicate when momentum is coming out of the market and it's more likely to reverse. If the market retraces back up in an opposite direction to our trade, this can be used as an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with Bollinger Bands and moving averages. We can see the market is at the top of the Bollinger Band, but we could also wait for the MA cross before taking the short trade. And now we have a confluence of 4 indicators. We have RSI coming back out of overbought. We have MACD cross with the market going to the edge of the deviations on the Bollinger Bands. We also have the 2 MA crossing to the downside. This is the sort of confluence you should be looking for with technical indicators on various markets to see how you can find opportunities to take profitable trades. I hope that you found this presentation useful. If you have any questions, please contact a senior account manager. Goodbye, and please join us at Fortrade again soon.